Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're discussing why 3 of Canada's largest banks have decided to raise their fixed mortgage rates even though bond yields have been subdued. This development has puzzled many, considering that bond yields, which generally influence fixed mortgage rate pricing, have actually dropped by more than 30 basis points over the past 2 weeks. Typically, when bond yields decrease, we expect mortgage rates to follow suit. But that's not the case here. Banks like CIBC, Royal Bank, and TD have increased their 3, 4, and 5-year fixed rates by 15 to 35 basis points last week. Royal Bank also raised its 5-year insured and uninsured variable rates by 10 basis points. These changes are not isolated, as other lenders across Canada have also upped their fixed rates, primarily in the 3 to 5-year term range. While some lenders have slightly reduced select rates, the overall trend has been upward. So, why are rates going up when the yields are down? The answer isn't straightforward. Rates are influenced by a mix of market conditions, geopolitical events, domestic data, and broader future outlooks. Mortgage broker and rate expert Dave Larocque described the current rate changes as counterintuitive. He pointed out that lenders are reacting to a previous run-up in bond yields from early October, which saw an increase from 2.75% to 3.31% by late November. Larocque also mentioned that if bond yields remain low or fall further, we might see these rate increases reversed. But he cautioned that this outcome is far from certain. Another rate expert, Ryan Sims, noted that banks have been slow to adjust to the yield changes that occurred in November. Although the increases are now in place, they remain higher than before. Sims suggested that if bond yields stabilize, we could see some competitive rate wars. He also highlighted that with more borrowers opting for variable rate mortgages, banks might have to reduce fixed rates to attract customers. There's a risk for banks if they have too many variable rate mortgages due to potential mismatches between short-term liabilities and long-term assets, which can affect their profitability if interest rates rise. In addition, Ron Butler from Butler Mortgage touched on the seasonal aspect of these increases. He explained that it's typical for banks to end mortgage marketing campaigns around this time of year, leading to rate hikes in December. Despite the recent drop in bond yields, he pointed out that 3- and 5-year yields are still higher than they were in October, which contributes to the current rate scenario. Looking ahead to 2025, we're seeing a lot of anticipation surrounding potential rate cuts and rule changes that could lead to a mortgage boom. With weak economic data recently released, the Bank of Canada seems to have the green light to continue lowering interest rates. In addition, new rule changes aimed at boosting housing affordability are on the horizon. This combination of factors is setting the stage for a possible surge in the mortgage market next year. According to RE/Max Canada, 36% of Canadians are optimistic about the 2025 housing market. They project a 5% national price increase as many regions shift back towards a seller's market. The Bank of Canada's interest rate cuts, along with the expansion of 30-year amortizations for first-time buyers and an increase in the mortgage insurability cap, are creating favorable conditions in the industry. Shubha Dasgupta, the chief executive officer of Pineapple Financial, commented on this positive trend. He noted that we're seeing progress in affordability and that the Bank of Canada is working towards a neutral interest rate. Consumer sentiment is at a 30-month high, which is significant in a sentiment-driven industry like real estate. When people feel positive, they're more likely to participate in the market. Starting December 15th, new rule changes will allow first-time homebuyers to amortize their mortgages over 30 years, up from the previous limit of 25 years. The maximum home value eligible for an insured mortgage will also rise from $1 million to $1.5 million. While these changes are expected to positively impact the market, Dasgupta advises brokers to maintain a cautiously optimistic outlook, anticipating steady rather than explosive growth in 2025. Another area of opportunity for brokers in the coming year is renewals, as many Canadians are set to renew their mortgages. A recent regulatory change has removed the stress test for uninsured switches, which is beneficial for consumers. Dasgupta emphasizes the importance of brokers connecting with existing homeowners to explore options that might save money or better structure their debt. In terms of borrower types expected to be active in 2025, Dasgupta advises brokers not to concentrate on a single client profile. Instead, a broad approach is recommended to capture growth opportunities across different borrower types. This includes a focus on multi-unit residential development, a sector experiencing strong growth. Insured volumes for multi-unit insurance products have risen significantly, indicating growing investor interest. Dasgupta notes an influx of applications for loans related to multi-unit residential developments, whether through CMHC's MLI Select product or other financing vehicles. This resurgence of investor interest, albeit in a different format, suggests that brokers should align their strategies to cater to these evolving needs. Kitchener Centre Member of Parliament Mike Morris is pushing for a significant change in how affordable housing is defined in Canada. Morris recently announced a private member's motion that aims to alter the criteria used by the Canada Mortgage and Housing Corporation, CMHC, when allocating funds for affordable housing projects. Morris argues that the current use of federal housing dollars is inefficient due to the varied definitions applied by different entities seeking funding. Currently, CMHC defines affordable housing as housing that costs less than 30% of a household's pre-tax income. However, Morris points out that there are at least 6 different criteria being utilized, which deviates from this standard definition when organizations apply for government funding. According to Morris, this inconsistency is part of the reason why housing costs have surged, while wages have not kept pace, exacerbating the housing crisis. The motion, known as Motion 170, seeks to simplify the definition of affordable housing into 2 categories: affordable and deeply affordable. Morris proposes that CMHC should adhere strictly to the definition where housing costs do not exceed 30% of pre-tax income. Additionally, he introduces the term deeply affordable to refer to housing for those earning less than 50% of the average income in their community. In a statement to City News Kitchener, a media relations officer from the Office of the Minister of Housing, Infrastructure and Communities emphasized the need for a diverse approach to solving the housing crisis. The officer highlighted that the federal government has implemented the most ambitious housing plan in over 4 decades, aiming to increase the supply of various types of housing, from middle-class apartments to social housing for vulnerable populations. The plan's core commitment is to ensure no Canadian pays more than 30% of their income on housing, addressing the crisis through multiple targeted measures. Morris believes that by establishing these clear definitions, federal funds can be more effectively directed to genuinely affordable housing projects, thereby helping to alleviate the housing crisis. While this motion is a step towards addressing one aspect of the broader housing issue, it reflects ongoing debates about how best to manage housing affordability in Canada. As the real estate market in Ontario continues to experience a slowdown, many homes are selling for less than their asking prices. This trend has been particularly evident over the summer and fall months, with some notable price reductions in various regions across the province. For instance, a home in Mississauga sold for nearly $700,000 below its list price in October, while a property in Brampton experienced a $487,000 loss in September. Despite expectations for a market rebound in the spring, sellers are currently lowering prices to attract buyers in this sluggish market. Real estate brokerage. Zoocasa has compiled a list of homes that have recently seen price drops across Canada, highlighting several properties in Ontario. Let's take a closer look at some of these homes. Starting in Toronto, a 1-bedroom condo at 906 47 Mutual Street, located in the Garden District condos, saw a price reduction. Originally listed for $555,000 in August, the price was dropped to $499,900 by November. This unit features a den with an unobstructed east view, along with upgrades like a handheld shower, induction cooktop, waterproof vinyl flooring, and Italian porcelain bathroom tiles. The building itself offers amenities such as a pet spa, a two-story gym, and a communal workspace. Moving to Oakville, a three-bedroom home at 1180 Falgarwood Drive also experienced a significant price drop. With a beautiful ravine lot, this home offers an open layout and large primary living spaces, including a spacious kitchen with an eat-in breakfast area. The property was initially listed at $1,499,000, but the price has been reduced to $1,349,000. In Etobicoke, a charming detached 1.5-story home at 10 Smith Crescent is now listed for $1,099,000, down from its original price of $1,195,000. Nestled in the Stonegate Queensway community, this home boasts hardwood floors and a wood-paneled sunroom, among other features. Over in Whitby, a 4-bedroom, 4-bathroom home at 11 Macbeth Place has also seen a price adjustment. Situated on a corner lot in Brooklyn, the home includes new oak staircases, renovated bathrooms and kitchen, and a backyard with an in-ground pool. It was originally listed for $1,599,999, but sold for $1,545,000 on November 24. Lastly, in Cambridge, a beautifully restored 1887 house at 22 Harvey Street offers a unique blend of Italianate architecture and Queen Anne details. With 10-foot ceilings, original pine floors, and late 19th century doors, this home was listed for $1,200,000, but has since been reduced to $1,175,000. These price reductions across Ontario reflect the current challenges in the real estate market, but they also present opportunities for potential buyers looking to invest in properties at more affordable rates. As always, staying informed and understanding market trends can help you make the best decisions in your home buying journey. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.